Good afternoon, everybody. My name is Mark Benzaquin. I am the Manager Investor Services here at the OIC. Today we're going to be talking about credit spreads and how we sell credit spreads, why we sell them, the ins and outs of trading spreads. We're going to get started with a few housekeeping items. Our standard disclaimer: options involve risks and are not suitable for everyone. As a matter of fact, you should be familiar with the characteristics and risks of standardized options booklet. If you don't have a copy and would like one, you can find one on our OCC website. You can also contact your broker or the OIC for a complimentary copy. And to keep things simple today, we're not going to be discussing in-depth commissions, fees, margin, things like that. We're going to keep our examples simple to understand. And speaking of those examples, any strategies that we discuss are simply going to be for illustrative and educational purposes and not intended as a recommendation. Speaking of OIC, for those that aren't familiar, we are a free and unbiased options education group. We do most of our educational resources from our website, optionseducation.org, where we have online courses, podcast videos, and obviously the webinar program that we offer twice a month, as well as live options seminars once a quarter. The pride of OIC is our Investor Services Help Desk. You can get live options help via email at options@theocc.com or check out our website where we have a live chat feature as well. The OIC supports the U.S. listed option exchanges. You can see here are the 5 main exchanges. Each of those exchanges, due to buying other properties, have anywhere from 1 to 5 additional exchanges under their umbrella, for a total of about 15 or I believe even 16 exchanges now. And those exchanges are responsible for this boom in options volume that we saw certainly over the last year, record volume of about 5.4 billion contracts. So even though volatility may be low, as some say, the options industry as a whole is in terrific shape and things are going along swimmingly. So let's get to the presentation. We're going to be talking about spread trading. We're going to start out with the basics of spreads, what it is, different kinds of spreads, what is a vertical, what is a calendar, and what is a diagonal, before we get into the meat and potatoes of today's presentation, which is vertical spreads for income. We're going to talk about a bear call spread as well as the bull put spread. And one of the questions that we get asked most often at the OIC Help Desk is, how do we choose a strike and how do we choose an expiry? So we're going to get into those as well, as we're going to wrap things up with position management and some Q&A towards the end. So spread basics. What is a spread? Well, simply put, a spread is a position that involves, well, I should say a spread is a trade that involves 2 or more positions. Typically, we've got an option contract, and then we're buying or selling something else, whether it's another option, another stock, or another product. We may or may not have the same underlying, we may or may not have the same expiration date, and we may or may not have the same strike prices. Different types of spreads. The most popular are vertical spreads, which we're going to discuss today. Horizontal spreads, also known as time or calendar spreads. And while we're going to get into vertical spreads, just briefly talk about time spreads. Time spreads we use to take advantage of changes in volatility, whereas vertical spreads, we're looking to take advantage of price differentials between the strikes as expiration approaches. Horizontal spreads, we're looking to take advantage of those volatility differentials, those volatility changes. There's also diagonal spreads that are kind of a combination of the two, taking advantage of price changes as well as volatility changes over time. How do we know if we're looking at a vertical, calendar, or a diagonal? Well, the terms come from back in the day when your option chain used to be published in the newspaper, for example, and the strikes would be listed vertically up and down the page. The months or the expiries would be listed across the page horizontally. So, for example, a vertical spread, we would look up and down. In this case, the 85 call and the 90 call, that would form a spread. We're buying one of those contracts and selling another one. When it comes to the calendar, we would simply look across the page between strikes. The 97.5 call, between November and January. And again, we're looking to take advantage of those changes in volatility from that time period. And then the diagonal spread is a combination of the two. So obviously a fairly simple concept. Some people do ask us where those terms come from, and there you go. There's a little bit of options trivia for you. So vertical spreads, what we're talking about today, all calls or all puts, same expiration and different strikes. The example that I have up here on the screen, we've got an 85.90 call spread. We'd be buying that versus a separate trade, a January 90.80 call spread. In this particular case, we're selling it. Now, it depends on your vernacular. Me on the trading floor, the low strike was always listed first, meaning that it's the 85.90 call spread. We'd be buying or selling it. It'd be the January 80.90 call spread, buying or selling it. I do know a lot of individual investors, the strike that they put first in their spread when they talk about spread trading is the strike that they're purchasing. So in this case, we're buying the November 85.90 call spread. In the other example, we're selling the January 90.80 call spread. The thing about a spread is when we're buying it, we're always buying the more expensive strike and we're selling the less expensive strike. So if we're buying a spread, also known as a debit spread, we're buying the more expensive strike, selling the less expensive. When it's a call spread, we'd call it a bull call spread. A put spread, it's a bear put spread. So again, if it's a debit spread, if we're putting out money initially, a net debit, we're buying that spread. Conversely, it's going to be the opposite when we're selling. We are selling the expensive strike and we're buying the less expensive strike. In the examples that we're going to be talking about today, we're going to be looking specifically at the bear call spread and the bull put spread. Now, one of the things about spread trading, and actually my favorite thing about spread trading, and this is a statement that I make with customers that we talk to all the time, with investors. The terrific thing about spread trading is that you're trading with your eyes wide open, meaning that we know going into the trade what our maximum risk is and our maximum reward. Defined risk, defined reward. If we're buying a spread, our debit spread, our risk is simply going to be the premium that we paid for the contracts. Anytime you're buying options, whether it's simply buying a call or buying a put or a combination of spread trading, anytime we have a net debit, anytime that we have more money going out than coming in when we put on the trade to begin with, that is going to be a net debit. So anytime we buy options, the most that we can lose is the premium that we pay for that option. So that's going to be that defined maximum risk. Our defined maximum reward in the case of a debit spread or buying a spread is simply going to be the difference between the strikes minus the premium paid. If we had, for example, a 50 strike call and a 55 strike, and we buy the 50 because we know that's more expensive, we're selling the 55, the cheaper strike, and let's say we do the spread for $1, a net debit of $1. Well, our maximum risk is going to be that dollar that we pay. Our maximum reward is going to be the difference between the strikes, in this case $5. That's going to be the maximum value of the trade. The spread will never be worth more than $5. That's going to be the maximum value. We're going to take that $5 minus what we put into it, in this case $1, and that's going to be our maximum reward. Difference between the strikes minus that net premium. Now on the other side, with the credit spread, it's going to obviously be the exact opposite. If we're buying a spread, we know that the premium that we paid is the most that we have at risk. That risk is going to be the maximum reward for the seller. If I'm paying $1 and that's the most I'm risking, the person collecting that dollar is going to be the most that they can make. With the credit spread, our maximum reward is going to be the premium we receive. We can never make more than that premium that we collected up front. The maximum risk, again, is going to be the opposite from it was on the debit spread. Remember, the debit spread, our maximum reward was the difference between the strikes minus the premium paid. With the credit spread, our risk is going to be the difference between strikes minus that credit received. So again, defined risk, defined reward. If we're buying a spread, the most that we can lose is that which we paid for it. If we're selling the spread, the premium that we collect, that's going to be the most that we can receive. Now, the important thing to remember here is that that defined risk is only going to exist while we're in the position. Let's look at the debit spread, for example. We buy a 50-strike call. We sell a 55-strike call against it. We've got that bull call spread on. If we choose to exercise our long position, remember, we can only exercise that which we own. So we can only exercise our long call. If we choose to exercise that long call, that's going to turn that option position, that option call, into stock. So now we're going to be left with a long stock position and a short call against it. That's assuming we exercise the position prior to expiry. So now where we had a bull call spread, now we've got basically a covered call. So that defined risk that we have, that risk-reward parameters, that's going to exist only while we have that position. Or even let's take it out further at expiry. We exercise our position, we're left with long stock, or we're left with short stock, let's say. Now we've got a new risk-reward position of long stock or short stock. So, definitely something to keep in mind, that defined risk is only going to exist while we're in that position. So a bear call spread, what exactly is it and why do we do it? Simply a bear call spread, as we talked about just a moment ago, we are selling the more expensive strike and we are buying the less expensive strike. The idea being is our forecast and motivation. And let me back up for a second. If you've seen any of our presentations, or if you've seen any of my presentations, I should say, you know that I preach over and over that any option trade begins with two things. Your forecast for the underlying, what's going to happen, where's it going to go, and how long is it going to take to get there. And then motivation. Why are we doing the trade? Are we putting on the trade to generate income? Are we putting on the trade to protect our portfolio or protect our stock? Are we doing the trade to maybe buy stock below the market? What is the reason that we're doing the trade? Selling options, first and foremost, our motivation is going to be income. Right? We want to collect that premium up front. We want to keep as much premium as we can as profit. That's going to be our income. Our forecast, well, with the bear call spread, obviously we're bearish, right? We think the stock is going to be, somewhere between neutral to declining in value. And because we're looking for income, an investor may choose to sell stock short, or they may look to simply sell calls against it. The problem with doing either of those, certainly depending on your risk tolerances, or I should say the issue with either one of those is if we're selling naked calls or we're selling stock short, while they both give us premium to collect up front, but it also gives us unlimited upside risk. We've got no protection if the stock goes from 50 to 500, let's say, for example. And as option traders, risk is something we're always looking to control. We're always looking to limit the amount of risk that we're willing to accept with the trade, or limit the amount of risk that a trade offers to us. So to offside that upside risk that we potentially have by selling a naked call, for example, we can buy ourselves some protection. We're going to buy an out-of-the-money call, and granted, we're going to give back a little premium to do so, but that's going to give us some protection to the upside should our forecast be wrong. And let's look at a hypothetical scenario here as to why we would do such a trade. So after repeated missed earnings and lowered expectations, an investor is bearish on Dollar, a hypothetical financial services company. To take advantage of our forecast, we're looking to either sell stock short or sell calls. All right, so this scenario tells us a couple of things. What's our forecast? Well, our forecast is that we're bearish. We're expecting the stock to go down, or at worst, maybe remain neutral between now and expiration. We're also looking to generate income because we're looking to sell options and we're looking to generate income that way. So we can do a couple things. We can sell our stock short, sell 100 shares short, but if stock stays flat, then obviously we're not going to make any money. And we don't have any protection if the stock takes off on us and goes the other way. We can also sell a naked call, but just like selling stock short, it's not going to offer us any upside protection. Both trades also would likely require significant margin from your broker if our account is even approved to have a short stock position or to sell options naked. So definitely something that you want to keep in mind. To protect ourselves on the upside, we're still interested in selling that call because we do have that bearish outlook and we want to generate income, but we don't want to do so without protection. So what we may choose to do is sell that call, but also buy another out-of-the-money call against it in order to reduce that upside risk. It's also going to reduce our margin requirement. When it comes to margin, and we'll talk about that in just a little bit, but margin requirements are going to vary from trading firm to trading firm and from account to account, so you'll definitely want to discuss the margin policy with your broker. So here we go. Our stock is trading $50. Our expectation is flat or hopefully declining shares within the next 60 days. To take advantage of our forecast and motivation for income, again, there's that phrase, forecast and motivation. What we wanted to do initially, remember, is we wanted to sell a naked call. In this case, we're going to sell 5 of them. With the $50 strike, we think the stock is going to be neutral, so staying around 50 or declining, so below it. So we can sell that call. Trading at $1.65, we sell 5 of them. Because we want some upside protection just in case our forecast is wrong, right? We can't always be right. As I tell my wife often, I can't always be right, and for the times that we're going to be wrong, we want some protection just in case that happens. So we're going to sell the 52.5 call. I'm sorry, we're going to buy the 52.5 call. That's going to cost us 65 cents. Now we're going to get into a little bit later strike selection as well as expiry, but I just want to make a comment here. We're selling the 50 strike call. We're collecting $1.65 in premium. When it comes to strike selection for our protection, right, we're going to be buying options for protection. Well, obviously that's going to cost money. So we're going to look at a couple different scenarios. Here I looked at the 52.5 call and said, well, I'm protecting myself anywhere above $52.5 in case the stock takes off on me. To do so, I'm going to be giving back 65 cents of that premium that I collected. And I'm okay with that. That's going to give me a net credit of $1 or $100 per contract. That's going to vary from investor to investors. Some investors may say, I don't need that much protection, and I would be willing to buy back, say, a further out-of-the-money call, maybe a 55 strike. And maybe that 55 strike is only trading for 15 cents, in which case they would be giving back less of their premium, and they would be receiving a larger net credit. The downside to it is it's giving them more risk. In the example I have here, you've got $2.50 of risk, the difference between the strikes. Again, minus the premium that you collect. But in terms of the spread by itself, you've got $2.50 of risk. If you choose a further out-of-the-money strike, such as the 55, now you've got $5 worth of risk. So you've doubled your risk in return for only another 50 cents or so of premium. It's obviously going to vary from investor to investor whether or not they're going to be okay with that trade-off. Or the investor may want even less risk and choose a $51 strike or a $52 strike, something like that. The point being is that it's going to be a balance of risk versus reward. How much are you willing to accept in terms of risk, and how much reward are you willing to give up. And again, as I had explained, we'll get into that a little bit later in more in detail. So we sell the 50 strike call. We buy the 52.5 for protection. It's going to afford us a net credit of $1. We're selling 5 of these contracts, so the total premium that we collect up front is going to be $500. And again, as I had mentioned, one of the great things about spread trading is the defined risk and defined reward. So in this particular case, our maximum gain is going to be $500. Now, how do I know that? As I explained, we're net selling spreads. So the most that we can collect, in this case, is $1. Our maximum premium, or our maximum reward, I should say, is going to be the premium that we collect up front. Our net credit of $1, that's the most that we're going to be able to make on a spread. We sold 5 of these spreads, so that's going to be $500. The maximum risk, remember, is going to be the difference between the strikes minus the premium collected. So we've got the 50 and 52.5 call. That's going to be a difference in strikes of $2.50 minus the $1 premium that we collected up front. It's going to be $1.50 worth of risk. We've got 5 contracts. That's going to be $750 of risk per trade. So we've got 5 contracts, a maximum risk of $750. The most we can make is $500. The most we can lose is $750. Now, you may be asking yourself, why would I risk more than I can collect? And it's a very good question. And again, the answer is going to vary from investor to investor. But the way I look at it is this. What is the likelihood of this trade being profitable? It's almost like, and I don't like to compare option trading to gambling or the lottery, for example, but you spend $2 on a lottery ticket to potentially win $20 million. Certainly that risk versus reward ratio is fantastic. That's what we're looking for in everything. However, the likelihood, the probability of winning the lottery is obviously minuscule. So even though you've got a terrific risk versus reward ratio, the likelihood of that trade, or in this case that lottery ticket, being worth anything is very, very minimal. Kind of the same thing here when it comes to spread trading. I'm risking $750 to make $500. That may not necessarily make sense unless the likelihood of making that $500 is far greater than the likelihood of losing that $750. So probability is something that you're going to want to look into. Some people consider delta to be an indicator of probability. In this case, we're selling options. So let's say this spread had a net delta of, I'm just arbitrarily going to pick a number. Let's say it had a net delta of 20. So that tells me that there's only a 20% chance of this spread finishing in the money, which means there's an 80% chance of this spread expiring worthless. And as option sellers, that's what we're looking for. Our end game is for the spread to expire without value, and we keep that profit, that upfront premium, as 100% profit. So maximum gain $500, maximum risk $750. That maximum risk we would also estimate to be the minimum margin requirement as required by your broker. And as I mentioned earlier, and I'm going to expound upon it just a little bit here, it's going to vary from broker to broker as different brokerage firms have different policies when it comes to their minimum margin requirement. So definitely check with your broker to see how their margin requirement is going to apply directly to your trading account. Our break-even point, $51. That break-even point is where we begin to make or lose money. Now, how do I know that's $51? Let's say that we are assigned on our short call, our short $50 call. We sold that $50 call, so that obligates us to sell stock at $50 if we get assigned on the contract. If we're forced to sell shares at $50, but we were paid $1 up front, to accept that obligation, theoretically we're actually selling that stock at $51. So that's how we look at our break-even point. Anything below $51, we're going to make money. Anything above 51, we're going to begin to lose. And this is what happens at expiration. I should have prefaced this. The maximum gain, maximum risk, etc., break even, that's going to be at expiration. And the reason being is at expiration, we know that options are worth either zero if they're out of the money or if they're at the money, or they're worth their intrinsic value if they finish in the money. So at expiration is the only time that we can tell what our maximum gain, what our maximum risk is going to be, and where we stand on that break even. And let's go ahead and look at it from a graphic P&L sense. For those of you that don't chart out your trades, that don't graph out your trades on a P&L, for me and for many traders that I know, it's the easiest way for us to visualize where do we begin to make money, where do we begin to lose money on the trade. And again, this applies only at time of expiration. But it helps us visualize if the stock is currently trading, for example, 55, by plotting this out ahead of time, you're going to see that if things stay as they are at time of expiration, you're going to have a losing trade. So it might be time to look into managing the position. So let's assume this is at expiration. If shares finish below $50, both of our legs are going to expire worthless, which as option sellers, that's what we're looking for. And we achieve our maximum profit. Remember that maximum profit was $1, the premium that we collected up front. And we've got no stock position, meaning that we're not long or short on the underlying at expiration. If shares finish between our strikes, between 50 and 52.5, we would expect our short call to be assigned. That long call is going to finish out of the money, and because our short call is assigned, we are now obligated to sell shares. If we already have the stock in our account, that's wonderful. We'll simply deliver the shares that we have on hand. If we don't already have those shares in our account, then we're going to need to borrow those shares from our broker and establish a short stock position. That in itself may come with fees and certain requirements from our broker. So again, it's important that you're familiar with your trading firm's policy and position, not only for your specific trading account, but in general on short stock. So definitely talk with your broker about that. So if shares finish between the two strikes, we may be left with a short stock position. If they finish above our long strike, remember that's the 52.5 call that we bought for protection in case we were wrong, and it's a good thing that we did, because if shares continued to take off, our loss would continue to increase. Because we bought that 52.5, both the short call is going to be assigned, our long call we're going to exercise. That's going to minimize our loss, cap our loss at $2.50. However, we collected $1 up front, so this is where we achieve our maximum loss of $1.50. So anywhere that shares finish above $52.50, we've got that protection on the upside. When we get assigned the short call, our long call is exercised, our stock position is flat, and that is how things are going to finish at time of expiry. Now, so that's the bear call spread. Let's take a look at the bull put spread and how that works. Bull put spread, here's our situation with an expectation of neutral to moderately increasing share prices. Again, we're selling options, so we have that motivation for income. We might be looking to sell puts or buy stock. We can certainly sell naked puts, but that's not going to offer us any downside protection. Or we can simply buying shares, but by buying shares, 100 shares of stock obviously can be certainly capital intensive, especially depending on the stock. If we were looking to buy Amazon, for example, at 1,800 plus a share, that's obviously going to require a lot of money up front, and there's a lot of money at risk. So we can either sell these naked puts, we can buy shares, or we can simply offset the risk of the decreasing prices by buying an out-of-the-money put. Another thing that I want to mention, when it comes to selling options, we had talked of how share price is, obviously share price is essential in determining the value of the spread, both at inception and at time of expiration, and everywhere in between. Another pricing component that we need to be cognizant of is volatility. What some investors may do is at periods of high volatility may choose to sell options because periods of high volatility lead to high option prices, both for calls and puts. So the idea at periods of high volatility is let's sell the options while they're expensive with the expectation that the prices may come back down to earth and settle more at their historic level. So when we talked about that forecast and motivation, part of that forecast, in addition to forecasting the price, is also forecasting where that volatility may be. So definitely something to keep in mind. And here's our scenario for our bull put spread. We're neutral to moderately bullish on Bubble, which is a $115 a share soft drink company. Rather than commit a little over $11,000 to buying 100 shares, we're going to look to sell puts, with the idea being that maybe we can buy the stock below the strike price or simply take advantage of high implied volatility levels or take advantage of a neutral to moderately increasing market. So we're going to sell that 115 strike put. That's going to obligate us to buy shares at $115 if we get assigned. If we're wrong on our forecast, by selling that put, we're obligated to buy stock at $115 if we get assigned. If shares finish at 0 at expiration, well, that's a heck of a lot of downside risk. So to mitigate that risk, we're going to buy an out of the money put, in this case the 110 strike. That's going to give us some downside protection again, should our forecast be wrong. Here's our scenario, 115 strike put, we pay $2. We sell at $2, and for the protection, we're going to pay 70 cents for the 110 strike. It's going to give us a net credit of $1.30 per spread. Our maximum gain, obviously we know this, right? This is easy. We're collecting $130 or $1.30 per option contract up front. That's the most that we can make, right? That's easy. Our maximum risk is what? Remember, we calculate our maximum risk as the difference between the strikes minus the premium that we collect. So minus that $1.30, we've got a $5 spread minus the $1.30 we collect up front. It's going to give us $3.70 per option contract, or $370 worth of risk. Again, in this example, the most we can make is $130. The most we can lose is $370, almost 3 times. We may do this trade if we feel that there's a high likelihood, again, a high probability that this trade is going to finish out of the money, which is what we're looking for as option sellers. Maximum risk of $370 also means that we would expect a minimum margin of $370 as well. And our break-even point, $113.70. I know that because if I'm obligated to buy shares at $115, remember, that's my short put. So when I'm selling options, I'm accepting an obligation. With the case of puts, I'm accepting an obligation to buy shares at the strike price. So I would be buying shares for $115 if I get assigned, but because I was paid $1.30 up front, theoretically it's almost the same thing as buying those shares for $113.70. That's my break-even point. I know that if shares finish above $113.70, I'm going to be profitable. And again, I can see that when I chart out the strategy. There's my break-even point of $113.70. If shares finish above it, I make my maximum profit. Both legs expire worthless. I have no stock position. Shares finish anywhere in between the two. My short put gets assigned, and now I am long stock. I own those shares from 115. To determine whether or not I'm still profitable is where can I sell those shares that I just bought. If I can sell them above 113.70, remember that's my break even, I'm going to make money on the trade. If I have to sell them below 113.70, I'm going to lose money down until my maximum loss is achieved at 110. That's where the short put gets assigned, the long put gets exercised. So those shares that I bought, I now have the right to sell at 110. I've got no stock position, but I do have that maximum loss of 370. So those are our examples for the bear call and the bull put spread. Let's get into, like I said, the question that we often get asked is, how do I choose a strike? And unfortunately, a lot of the questions that we get asked at the investor services desk, they don't necessarily have a black and white answer. And the reason being is because many of them depend on the investor, depends on their forecast, depends on their motivation, depends on their risk tolerance, right? There's all of these different factors that go into and differ from investor to investor that it's hard for us to tell you this is the way to choose your strike, this is the strategy to use, something along those lines. First and foremost, for those of you that have contacted us at OIC, you know that we don't make recommendations and we don't provide advice. What we simply do is provide education. So all that we can do is give you some ideas as to what to look for when choosing strikes and expiry. First and foremost, it's going to be a balance of risk versus reward. When we sell that option, certainly if we sell an in-the-money strike, that's going to give us a greater reward. In-the-money strikes cost more, or in-the-money strikes command greater premium than at or out-of-the-money strikes. So by selling that in-the-money strike, it's going to offer us a greater reward. We're going to collect more premium up front. But it also is going to give us a greater likelihood of assignment. Now, whether or not you are comfortable with being assigned on your short strike, again, that's going to differ from investor to investor. But something to look at versus in, at, and out of the money strikes is that in the money strikes, while it offers us greater reward, it also can potentially result in greater risk. So our forecast, that strike selection, it's going to be paramount, as well as the timing of this trade. It's going to be paramount in choosing how we go about doing this trade. If we don't think the stock is going to breach, say, $50, well, then we may choose to sell that $50 strike. And then we would simply buy an out-of-the-money strike against it to give us that protection. But let's say we're even more aggressive. If shares are trading 50, and let's say we're talking call spreads here. We're looking to sell a bear call spread. We're aggressively bearish on the stock is now trading 50. We think the stock is going to go down significantly from where it is now. We may choose to sell a 45 strike and maybe buy the 50 strike as protection. The point being is we may choose to sell an in-the-money strike because we're that confident in our forecast. That's going to allow us greater reward by selling a more expensive option. So that short strike is going to be the pricing boundary, as I call it. For calls, it's going to be the upper price range. For puts, it's going to be the lower. It's going to be that pricing boundary of where we think the stock, kind of look at it as a ceiling or a floor. We don't think the stock is going to get above this price, or when it comes to puts, we don't think the shares are going to get below that price. And then simply the long strike is going to be protection. How much protection do we want, and how much are we willing to pay for it? So that's going to be how we determine those strikes. And I guess, I certainly understand that, I'm not giving concrete examples. There's no formula that I'm giving in terms of, sell something 5% out of the money and buy something 10% out of the money. You can certainly do that, but that one size fits all when it comes to option trading. It simply doesn't exist. So strike protection, or I should say strike selection, it's going to be a balance of risk versus reward. Whereas expiry, in a sense, it's the same thing. Short-term versus long-term. Option sellers is the best friend of option sellers is going to be theta, time decay, right? And it's going to accelerate within 30 to 45 days prior to expiration. So certainly you could sell a longer term option because, when it comes to options, time is money. We can sell a longer term option and collect higher premiums, but when we do so, the value of that option is going to decrease slowly. As an option seller, what we would prefer is for that option to decrease at an accelerated pace. And when we find that accelerated pace, generally 30 to 45 days out. So we may collect less premium up front, but we're going to get that acceleration that we want. The value of that contract is going to decay or get eaten away at a faster pace. Again, same thing with time as we had mentioned. The farther we go out, the more risk that we have, right? The reason that option premiums are higher the further we go out is because we've got more time for things to go wrong, right? There's more time for our forecast to be incorrect. There's more time for the market to go awry. There's more corporate events. There's more dividend payments. There's more Fed meetings, et cetera. As an option seller, I'm going to command a higher premium because there's more time for me to be wrong in terms of this strategy. So further dated options certainly have more premium that you collect. However, the risk there is that it's got more time for things to go south on you. And remember, that end game, as I mentioned earlier, the idea is that we want everything to expire worthless. We want both options to expire out of the money and worthless, so we keep that entire premium for ourselves. And maybe an easier way to do that is with less time. That option gets eaten away quicker, and we're taking less risk in terms of there's less time for things to go wrong for us. I've mentioned assignment over and over and over again today, and the reason being is, simply we're selling options. Assignment is always a risk of option sellers. Now, some people that may scare, other investors it may not. Again, it depends on what your motivation is. If your motivation is simply to get rid of the stock at a certain price, assignment's not scary. If your motivation is to buy shares possibly below the current market price, again, there may be nothing wrong with getting assigned. We may, choose to get assigned when we sell options. But as option sellers, we always need to be cognizant of the possibility of being assigned. Typically, that's going to happen at expiration, and you don't have to be a rocket scientist to figure out if I've got an in-the-money contract, the likelihood of that assignment is going to be great. It's probable that we're going to be assigned on an in-the-money option. Not guaranteed, but it certainly is likely. Early assignment, however, is something completely different. The problem with early assignment, if we're option sellers, and certainly if we're talking about a spread, we may be assigned early on our calls, and now that's going to leave us, we're going to have to deliver stock, and that's going to leave us with a either short stock position and also a long option. We may choose to exercise that long contract, that long call, to pay for that stock, or to get that stock, I should say. That's possible. But it may not financially make sense to do so. The good news is that early assignment generally only occurs in calls. It can certainly occur in puts as well, but generally in calls, and that it usually only happens in the case of a upcoming dividend. If the dividend amount is greater than the time value lost by the option holder exercising early, then that contract is going to be a candidate for early assignment. And I'll repeat that. Option components, as we know, there's extrinsic value, which is time value in this volatility, dividends, interest rates, et cetera, and intrinsic value. So when we exercise our contract, when we exercise a call, we're only exercising it for the intrinsic value of the option. When we do so, any extrinsic value, any time value that's left on the table, we're going to lose. So the only way that it's going to make sense in exercising that contract early is if the dividend amount is greater than the time value that we're going to be losing. And the reason being is if we exercise our call, we now are long shares of stock. Because we're shareholders, as long as we do this prior to the ex-div date, we are now entitled to that dividend. So just something to keep in mind when it comes to selling options. Always be cognizant of corporate events such as dividends and earnings and things like that. Certainly dividends in the sense of early assignment. So when it comes to puts, you may get assigned early. When it comes to periods of high interest rates, or if we're deep in the money, regardless, the idea being is as long as we're selling options, and if we're talking equity options, we could be assigned at any time for any reason. So it needs to be something that we're prepared for. If we do use that long option, as I had explained with the call, if we do use that long option to cover our short stock position, we're going to have a short stock position for one day. As I had mentioned earlier, that may have fees associated with it for our broker, or if we're talking puts, you may have a long stock position for one day, meaning that you're actually going to need to pay for that stock. So again, you should really be familiar with your trading firm's exercise and assignment policies, as they may vary from firm to firm, as well as their direct impact on your trading account. And I know that Ed spoke about this last week, pin risk. Pin risk may occur at expiration if the stock is just or below the short strike. The reason this is important for sellers is you may not know for sure whether or not you're going to get assigned. If your short position is right around the strike, there is a chance that you could get assigned on that position. Something that we have on the trading floor, a saying that we're very fond of is, when in doubt, close it out. If you don't want to get assigned on that position, if you don't want to take the risk of being assigned on that position, simply buy that contract back just prior to the close and get out of that position. You cannot be assigned on a position that you don't or that you no longer have. So we've got a few more minutes, just wrap this up with managing the position, because this is also something that people ask us about, and from time to time it can get a little confusing. So let's look at the bear call spread. We were talking about the bear call spread. Obviously, we want shares to decrease in value, flat shares or lower shares, or a decrease in implied volatility. Remember, periods of high implied volatility, high option prices, the idea being is if we sell something at $3, we would like to buy it back cheaper. If we can buy it back for $1 because volatility decreases or because the market decreases, all the better. Well, what happens if that doesn't work? What happens if the market doesn't decrease? What happens if volatility doesn't decrease and it does the exact opposite? Well, then we're left with certain choices. Roll up, roll out, roll up and out. This all goes back to forecast. So the market is up. We thought it was going to go down, but the market actually went up. Is it going to continue going up, or is it just maybe a temporary rally and we see things coming back to fit our earlier forecast? If things are continuing to going up, then we were wrong. Our bearish forecast was wrong, and maybe we simply close out of the trade and take our lumps, and maybe we put on a different trade to take advantage of that new forecast that we have. We were bearish, now we're bullish, so maybe we put on a trade to take advantage of that and try to recoup some of our losses. Maybe we think it's just a temporary rally, and we can roll out. We can, in a sense, buy ourselves more time to have our forecast come to fruition, to let that trade do the work. Maybe we roll it out to a new expiry. Or maybe we do both. We roll up the strikes because now our market forecast has changed, and we roll out the expiry as well because we need more time for that forecast to come true. So managing the position, again, it's going to come back to just like the strike selection. It's going to vary from investor to investor, and it's going to depend on where their forecast is, what they think is going to happen with that stock in the days and weeks to come. No different with the puts, right? With the bull put spread, we're thinking the market's going down. We think the market is going up, but if it goes down, or if there's again an increase in volatility, now what do? Do we roll down our strikes? Do we roll out our strikes? Or do we do a combination of the two? The point being is, again, there's no one-size-fits-all when it comes to managing the position. It's going to depend on the investor's risk tolerances. It depends on the investor's forecast. what is going to happen, and when is that going to happen. So managing the position, there's several different possibilities that you can do. Certainly feel free to get in touch with us at the Investor Services Desk, and we'd be happy to get into it a little bit more in detail with you. Just a quick reminder about the OIC. We've got a MyPath assessment if you're looking to assess your options knowledge and get started on a program of learning with our courses and podcasts and videos, and then our contact information. Definitely make use of our OIC help desk, our webinars that we offer, such as the one that you're listening to today. All of our programs are recorded and available for playback. Thank you for joining us. Again, if you have any questions, definitely make use of our Investor Services team. We'd love to talk to you. Have a great day, and thank you.